Hello investors and future investors, welcome back to the channel. Today's video will walk you through the world of dividend investing, which is one of the most passive forms of getting a regular paycheck. We will touch on dividend taxation and suggest a dividend portfolio setup like no other. So if you're ready to become a dividend investor or looking to increase your knowledge of this type of investment, then welcome to Investment Gains. Let's jump right into it. Dividend investing, or as I like to call it, the set it and forget it strategy, is a powerful strategy that should be a part of everyone's portfolio. The reason is that investing for dividend income can potentially pave the way for a more financially secure future. To use the set it and forget strategy means putting your dividend investing on autopilot, but more on this later. To kick things off, let's get into the basics of dividend income. What exactly is it, and how does it differ from other forms of investment returns? Dividend income is essentially the cash payments made by a corporation to its shareholders as a reward for holding onto their shares. Unlike capital gains, which depend on selling stocks at a profit, dividends provide a steady stream of income. The reason that investing for dividend income strategy is a set it and forget it strategy is that it can be put on autopilot, and you may never have to look at it again once you choose the right stocks or ETFs. To put your dividend investment on autopilot, an investor must first set up a recurring amount of money that is sent to their investment account on regular intervals. These funds are then used to purchase shares in dividend stocks over time. The last step would be to automatically reinvest the dividend received back into the company to purchase more shares. Hence, you set it and forget about it. Once your dividend portfolio has gotten to your desired goal, it will then be time to stop reinvesting the dividends and put those returns to another use that may make your life more enjoyable. Dividend investing is gaining popularity, and here's two reasons why. Dividend stocks not only offer a consistent income stream, but also have the potential for capital appreciation. And by focusing on companies with a history of paying dividends and a strong financial foundation, investors can build a portfolio that generates income and grows over time. I'm a dividend investor myself, and I'll reveal a few stocks in my dividend portfolio later in this video. If you're liking the video so far, remember to like and subscribe to the channel for similar content. It helps us to develop better content for you. Thanks much. Now, to become very successful at investing for dividend income, an investor must use some key metrics for evaluating dividend stocks. Before we go further with specific examples, it's crucial to understand these key metrics for evaluating dividend stocks. These key metrics are the dividend yield, the payout ratio, and the dividend growth rate. These metrics help investors assess the sustainability and potential for future growth of a company's dividend payments. The dividend yield refers to the dividend per share in dollars divided by the price per share and is usually displayed as a percentage. A good dividend yield should be between 2% to 6%, and this is very dependent on other factors as well, including your stock or ETF choice and your own investment goals. The dividend payout ratio is the percentage of the net income a firm pays out to their shareholders as dividends. So, what is a good dividend payout ratio? Generally speaking, a good dividend payout ratio of 30 to 50% is considered healthy, while anything above 50% can be seen as unsustainable. A good payout ratio allows the company to be able to consistently pay out dividends over a long period of time. The third metric is the dividend growth rate, and this measures a company's ability to increase the dividends it pays to its shareholders over time. General consensus favors a good dividend growth rate of being between 3 to 5%, and as you might expect, this will vary between different stocks and industries. A company's growth rate is determined on an annual basis and is referred to as the compound annual growth rate, or CAGR. Next, we will go over 3 examples of dividend stocks that hit all 3 of the criteria we mentioned previously. One of my favorite dividend stock company is Main Street Capital Corporation. Trading at just around $45 per share at the making of this video, Main Street Capital boasts a dividend yield of 6.4%, a payout ratio above 85%, and a 10-year dividend growth rate of around 5%. All that's good, but here's the kicker. Main Street Capital pays out dividends on a monthly basis, giving you more frequent payments. Now, it's important to remember that we mentioned earlier that a payout ratio of above 50% may not be sustainable, but like everything else, there are a few exceptions. Some industries require that certain companies pay out most of their net income as dividends, and Main is one such company. Another company that must meet this requirement is Realty Income. Realty Income is one of the most popular real estate investment trusts for dividend investors and is our second stock that hits all three criteria. With a dividend yield of around 6%, a payout ratio upwards of 90%, and a dividend growth rate hovering around 3%, it's very easy to understand why the stock is a part of so many portfolios. And just to add dessert at the end of your meal, Realty Income also pays monthly dividends. Our third example of a good dividend stock that meets all the criteria mentioned before would be Omega Healthcare Investors, ticker symbol OHI. With a dividend yield around 8% and a payout ratio north of 90% and a solid dividend growth rate, this stock hit my radar a few years back. It does, however, pay out dividends quarterly, which is well in line with the majority of dividend-paying stocks. The question now remains, what aspects are you going to use to build a successful dividend portfolio? All investments come with their own risks, and a sure way to minimize your risks is by building a diversified dividend portfolio. Diversity is key to a successful portfolio. When we speak of diversity, we don't mean a 10-stock portfolio. 5 stocks or fewer is ideal, and makes it easier for an investor to monitor and manage their portfolio. A dividend investor can also diversify their portfolio by sector, by risk management, or between stocks versus dividend index funds. Now, we did give 3 examples of stocks that meet the metrics we look for before adding to our dividend portfolio, and the reason they were mentioned is twofold. They are all part of my dividend portfolio because my videos are all about my personal investments, but most importantly, it helps to keep the portfolio diversified. Main Street Capital deals with debt and lending. Realty Income main business is real estate, and Omega Healthcare is straightforward. They do business within the healthcare sector. Always remember that a diversified portfolio will help to minimize risks, and a dividend investor must keep in mind that dividends are not guaranteed. Companies can increase, decrease, or cut their dividends altogether, so having a diversified portfolio will help with these unplanned outcomes. Also, to build your portfolio faster, an investor can apply the DRIP strategy. DRIP is short for Dividend Reinvestment Plan and is a strategy that allows you to automatically reinvest all dividends received back into the company to buy more shares, which compounds your dividend and portfolio growth. It's important to note that no investment strategy is without its risks and challenges. Some potential pitfalls of dividend investing includes economic downturns, interest rate fluctuations, and the impact of market volatility on dividend stocks. A dividend investor must have a long-term investment mindset and should be able to be patient while growing their portfolio. With dividend investment, returns are very small at the beginning, but after a few years you will be very happy that you pursued this type of investment. When it comes to dividend income taxation, I would highly recommend seeing a tax specialist. Different types of dividend income follow different tax classifications. For example, Energy Transfer's stock and Coca-Cola both pay dividend income. However, Energy Transfer is an MLP, which is taxed differently than Coca-Cola's dividend income. To conclude today's video, I hope you gained valuable insights into the world of investing for dividend income. Remember, building a portfolio that generates a reliable stream of income requires careful research, diligence, and a long-term perspective. If you find this video helpful, remember to hit the like button, share it with someone you think that can benefit from its content, and subscribe to the channel for more in-depth content on finance, investing, and wealth building. And as always, keep pushing your investments.